Standard trading guides often present a specific rule for the relative strength index. When the indicator crosses above the 70 line, the asset is considered overbought, suggesting a sell signal. This guideline assumes that market momentum acts like a stretched rubber band. The expectation is that once it extends to a certain limit, it must immediately snap back. However, in a strong primary trend, price often continues to surge to consecutive new highs, while the RSI indicator stays pinned or flatlines near the top of the scale. This is the flattening of the curve. Traders who short the market solely because the RSI hits 70 frequently watch the price climb for weeks while their positions move into deep deficit. RSI measures the rate of change through a specific calculation of competing forces. It is a calculation of velocity, providing different readings based on the acceleration of the price. Trading extreme levels without accounting for the internal rate of change treats the indicator as a static boundary. To use it as an effective signal, we must examine the exponential math driving the line. J. Wellis Wilder created the indicator in 1978 to solve a specific problem, isolating the timing of momentum shifts. He wanted to see if the internal strength of a move was actually keeping pace with the price. The formula compares the historical strength of a single asset against its own past performance. It does not account for the broader market or any external index. Unlike moving averages, which are lagging indicators that follow price, RSI is a leading indicator. It measures the underlying acceleration that precedes a significant price move. This acceleration is determined by two variables: the exponential moving averages of daily gains versus daily losses over a 14-period window. Identifying reliable divergences and reversals requires deconstructing this mathematical engine to see how it reacts to different types of price action. This model uses a standard 14-period exponential calculation to show the relationship between the up and down averages as price moves. In this scenario, the asset price increases by exactly $20 daily from day 16 through day 19. Because daily gains are steady but not increasing, the up average stagnates. The math sees this as constant speed, not acceleration. Consequently, even though price rises, the RSI value barely moves, advancing only by fractions, specifically 0.51 and 0.48. To push RSI higher, price velocity must accelerate. If velocity remains constant, the indicator loses its upward slope. This is why RSI flattens in strong trends. Without accelerating velocity, the engine records momentum decay even while price reaches new highs. Now we can introduce a minor counter-trend movement to see how the formula reacts to a sudden change in direction. On day 20, the asset suddenly drops $20. This matches the size of the previous daily gains, but in the opposite direction. Notice that the down average bar more than doubles in height. The exponential weighting of the calculation causes this single anti-trend close to exert a disproportionate influence on the average. The resulting RSI value crashes by 7 full points, a massive reaction compared to the fractional gains seen during the upward move. This mathematical weighting amplifies minor structural weaknesses in price action, forcing a significant shift in the indicator at the first sign of a trend pause. This bias allows RSI to identify cracks in a trend's foundation long before the price collapses. This mathematical overreaction is what generates the geometric pattern of a divergence. It provides a visual signal of momentum exhaustion. A bearish divergence occurs in a specific sequence. The price makes a new high at P1, pulls back with a red candle, and then pushes to an even higher high at P3. During the pullback, the down average spikes so much that RSI cannot exceed its previous high, even as price peaks again. This creates a failure swing, forming an M pattern below the 70 line, confirming momentum no longer supports the move. Structurally, this means institutional buying power is reaching its limit. The internal engine of the trend is losing pressure. This confirms that the primary trend is losing its underlying strength, making a significant retracement likely. While Wilder focused on exhaustion, Andrew Cardwell used these same mechanics to identify trend continuation. These signals are often called positive and negative reversals. A reversal occurs when institutional profit-taking causes a dip, which is then met by aggressive buying from capital previously waiting for a better entry price. This chart shows a positive reversal in an uptrend. We label the first valley W, the second valley X, and the peak between them Y. Notice the price makes a higher low, while the RSI makes a lower low. The lower low on the RSI is caused by the calculation bias overreacting to normal profit-taking, even though the price remains structurally strong. You calculate where price is heading. This shifts RSI into a framework for projecting exact price objectives. In practice, the primary risk for RSI traders is entering a position based on the very first divergence signal that appears. Strong trends often generate multiple consecutive divergences. The structural integrity of the trend might take several attempts to break before the price finally turns. The duration of the signal matters. Divergences that occur close together, within 2 to 6 periods, generally indicate a more immediate and aggressive shift in momentum. Execution requires confirmation from the price chart. A trader waits for the price to break support and establish a lower low before concluding that the divergence has triggered a trend change. A secondary confirmation often appears in the volume. If volume decreases as the price reaches its final peak, it supports the RSI signal that buying pressure has dissipated. The RSI identifies the mathematical anomaly, but the actual price action remains the final requirement for determining trade entry. Because the formula relies on the closing price of each candle, the RSI value will change significantly based on the timeframe you select. Professionals use a multi-timeframe approach. Checking a higher time frame, such as a weekly chart, provides confirmation of the primary trend direction. Moving down to a lower time frame, like the 1-hour chart, allows for an entry that coincides with the exact moment the micro-momentum shifts in the desired direction. RSI requires mathematical literacy to identify the specific moments where price and momentum decouple. It is a precise tool for calculating the balance of exponential gains and losses. Amateurs watch the 70 and 30 boundaries for overbought signals. Professionals look for the internal mechanics that precede a change in price direction.